and looking forward to what you are saying here today, what's going on the markets. Yeah, in the morning we have the Brexit vote. I think you will say something about this and important news for our professional traders. Please be aware that the leverage is reduced tomorrow and on Wednesday because of the Brexit event. So for more information, also check out please your mails or our company news, or for sure contact our customer service. So that's the important news. Now I'm quiet. Jay, it's your turn.
Hey, good morning, Tim. Pleasure to be back in the game. And let me get the right screen up and running, and hopefully you guys can see it. Let me double check. Can you guys see my screen? Can you hear me okay? Technicals all
Yes.
right? All right,
Yes,
super.
Jay, all is perfect.
Excellent. Well, thank you very much. Thank you for your kind words. It's great to be back. So I'm going to be a little bit careful in suggesting a trade for the week. A, because we have a great week with lots of volatility ahead of us. And B, I'm back from a week of vacation, and I always tread back carefully into the markets right after I've been gone for a week or longer. Glad for me to see that my traders, thank you, Andrea, for running our business while I was gone. We had some good trades that the guys took. And hang on one second. Before we get started, I just need to get this trade to break even here. 1 second. 77. All right. Good. Now I'm happy to trade with you because I'm short Aussie dollar yen. I talked to my traders all morning about it. We patiently waited for the short opportunity, and it's just what I call a scalp. For anything 20 to 30 pips is a scalp. It's not really a position trade. Doesn't matter because we're trading percentages. So if you risk 1% and you're looking to make 1.5%, I now have a free look to the downside, to liquidity below. We'll get into the trade in a second. So this is the first time that I'm giving you a trade at the beginning of the webinar. Hilarious. Okay, that's a picture of me. And famous Jay Medrow, I had to laugh my butt off just now, Tim, because I'm on vacation and I'm sitting there in a bar and a guy comes up to me. He's like, hey, are you Jay Medrow? Can I take a picture with you? And I'm like, wow, floored me. I've been trading billions at a bank and I've never had anyone anywhere in the world come up to me and say, hey, are you Jay Medrow? All of a sudden you're running a retail business and people come up to you. What a great experience, hilarious and funny. But hopefully, my hope and my intention with my co-instructors and myself is to make you guys better and to give you institutional knowledge. So here's the trade from 2 weeks ago that I was looking to enter. I was looking at the time to enter short New Zealand dollar versus Canadian dollar. We gave the reasons and we gave the areas where I was looking for the pair to actually weaken again. Now, if you have a full-time job and if you're in swing trading, then you have lost money on this trade. Why? Because at opportunity number 1, I put a 1 here, we see that you got stopped out. At opportunity number 2, you also got stopped out. So as a swing trader, part-time trader, you took a loss here, 1 or 2 losses. Again, please don't ever risk more than 1% on your account, especially when you start out trading. Now let's have a look at someone who has the time to actually sit in front of the screens, or as Andrea does it, for example, set up your trade station so that you get an email or an SMS, a text message alert, if and when a pair approaches the level that you're looking to trade. And then I have a lot of guys who trade semi-professionally, and they have a full-time job, and they set up their smartphone that they get an alert, and then they actually go into MT4 on their iPhone or whatever phone, and then they have a closer look. And we teach a very specific entry and exit signal. And my guys will actually look at this right now. And completely opposite to what the market did this morning, we had a very clean entry signal. Here, we neither got our signal at 1, nor by far not at all did we get it at 2. In fact, at 2, we got a long signal. So the one thing that I'd like to pass on to you guys, especially the guys who are not with us and who are new to trading, the big boys, what I used to be on the institutional side, we cannot hide our trades. Eventually, our volume will show up. And that's why it's very important that you learn to read correctly, amongst other things, correct technical analysis. And one of the things is What does the volume tell you in the chart? Now, we have a lot of important headlines to go through. We had a risk-off sentiment. Asian equities were softer. We have day number 24 for the US government shutdown. And if you are on Twitter, like we are, you will laugh your head off because lots and lots of smart guys keep tweeting on Twitter about, hey, the sun is coming up, people have birthdays, jobs are continuing, what do we need the government for? And rightly so, great humor, because there's some truth to it. Our governments are, needless to say, way too large and too expensive. But on the shutdown, Moody's said it last week, the rating agency, as other analysts. There's a current estimate in the market that every week that the shutdown continues shaves 0.1% off of GDP growth in the United States of America. And again, the two factors that institutional traders look at, also in the Forex market, that make up the basis for any and all decisions is GDP growth and inflation developments, okay? Those are the two main aspects that central banks in the Western economies look at. So we need to look at them as well. So if the shutdown continues, it's 0.1% off of GDP growth per week. Catastrophe. Then we had very weak Chinese trade data this morning. Not the balance, the trade data. So again, headline was green, but the details were pretty bad. And then we had thinner liquidity due to Japanese holidays. I don't recall if you guys recall 2 weeks ago, we had a flash crash overnight. There was a Japanese holiday, very thin liquidity during the overnight session. And then we had a flash crash in the Japanese yen. I happened to be in front of the screens at the time. So were a lot of the other guys in our WhatsApp group. And we actually traded it and made some money off of it. So if you're lucky, you get these events when you're in front of the screen. Asian equities, the ASX was unchanged. And then we had the KOSPI, that's the Korean, Southern Korean, obviously South Korea, not North Korea, South Korean, help me out, equity index. We had heavyweight Samsung and Hyundai actually weaker there. We had the Nikkei on holiday, Shanghai minus 80 basis points and Hang Seng minus 1.6%. What did the People Banks of China do? PBOC came in and stabilized with a net liquidity injection of 20 billion renminbi, the interbank market via reverse repo operations. Now, I could do a whole webinar with you guys on what reverse repos are, but that's basically one of the tools that the central banks around the globe use to steer liquidity in the interbank market. And the hope is that the banks within the system then use this additional liquidity to actually go into assets. So during, for example, quantitative easing, anything and everything that we studied at the university went out the back window, because when a central bank injects massive liquidity into the market, equities rise and bonds rise as well. And what you're being taught at the university is that if equities go up, you usually have a tendency for fixed income to come down. So a negative correlation. During quantitative easing, liquidity injections, you have positive correlations everywhere, all assets go up at the same time. Okay, I learned something new, hopefully, again. So capping losses via liquidity injection. Also of note, iron ore imports were at 6 months highs, actually, not lows. Very bad, Jay. For a perfectionist, this is horrible. So then you scan local papers as if you're really into it, like we are. And then the Straits Times, actually, I had to give you guys this passage because it's really good. China's December exports unexpectedly, that is the word that we're looking for to trade, fell 4.4% from a year earlier, with demand in most of its major markets weakening. Shitty situation. Imports also saw attention, shock drop, falling 7.6% in their biggest decline since July of 16. So congratulations, Mr. Trump, your trade war is working. Analysts had expected export growth to slow to only 3%, which is also horrible, with imports up 5%. And we had imports falling, shockingly falling, okay? So this morning, I get up, I read this into the WhatsApp group. I ask, what is today's trade? What is the trade right away? Because I don't have to look at anything else. I know exactly what to trade off of this situation. And I'll show you in a minute. Then we have Tuesday, the confidence, not the confidence vote, the Brexit deal vote. and it's expected to fail, and that's priced into the market. The cabinet is currently working on a plan B. That's pretty smart. Brexit is March 29, and we are currently working on a plan B. Leave it to politicians to mess everything up. Rest assured, they'll be able to mess everything up. Rumors are currently circulating on a draft legislation to be handed out today or introduced today for a second referendum. Interesting option. I prepared a whole slide on the Brexit situation, so bear with us here. This is cable. Cable means GBP versus USD, pound versus dollar. And that's a trade that I keep an eye on if I get a clean short signal at that liquidity zone where I put the marker, okay? But I'll give you some more levels in a minute. All right. Picture overnight, strength versus weakness. As we can see, risk off means Japanese yen rising. Here, where's my tool? Here we go. Japanese yen rising in the overnight session, and then the antipodons weakening in the overnight session. Because what is Australia? Australia is a suburb of China. So if China trade data is bad and Australia lives mainly off of exporting to China, that means the Australian currency is weakening. New Zealand dollar in accordance with, but there's a different there are different economic factors at work in New Zealand. We had this discussion this morning: should you short Aussie versus yen, or should you short New Zealand versus yen? Clearly Aussie versus yen. All right, risk events this week. I already wasted a lot of time, hopefully not wasted, but used up a lot of time. So we carry on into the slides that I prepared for you guys. Okay, take note now. Okay, hey, take note. This is important. So here we go, Brexit. Tuesday's Brexit vote. Any defeat by less than 100 votes is counted as a good result. That's how perverse it is. So weakness, if there's a lot more than 100 votes against, strengthen the pound if there's less than 100 votes. You need to be aware of this. Then, thanks to Nordea Markets, great Forex research, here is the roadmap to Brexit. So priced in is that the vote will fail. Plan B, not legally binding, could lead to the following outcomes: no deal, an extension of Article 50, general elections, as the opposition party will probably start their no confidence then, a second referendum, as alluded to early on. Supposedly legislation is being drafted up this morning to be introduced to us. There's also the possibility of a second referendum. So we have different options to look at. Article 50, second referendum, deal passing, deal being reintroduced in 3 days. That's new, general election and new deal. Because May now must return within 3 days in the event that the deal is voted down, which is priced in that scenario, and not the 21 days. Last week, the administration lost a piece of legislation, and now she needs to return within 3 days. That was this grievance period legislation piece. I don't know if you saw that or not. The headlines are getting very confusing. But even I, on vacation, was updated in between via Twitter and my guys. It's very clear that the EU does not want to renegotiate anything. It's not in their interest. And from the day that we had the referendum in 2016, my assumption, my opinion was that Britain is not leaving. Now, I could be completely wrong on that, but so far my scenario is not really out of the picture neither, okay? I think we could actually see a second referendum, but that could be accompanied by even civil unrest, because extreme left and extreme right people would then really start haggling it out in the street because they would use it as implying that the government can't be trusted, yada, yada, yada. All right, general election. If there was a general election, we have YouGov. You can Google it. It's a pretty good site that we actually look at on the institutional side. And their last estimates or polling results were 40% would vote for the Conservatives and 34% for Labour. But then you add this gigantic margin of error and you'll actually end up with no clear outcome. So a general election could really reintroduce uncertainty or continued uncertainty in the market. And the pound will not be able to keep elevated levels up in that case, because the market hates uncertainty. Pound options show the options market for pounds, for sterling, actually show that investors are positioning for a weaker pound in the second half of 2019. For my guys, that's the 6 months, 3 months risk reversals that we look at there. All right. So here are the scenarios and the outcomes that we need to take a look at. Second referendum, the pound could strengthen, probability of 25% being priced in. This is based on surveys by Bloomberg of 11 investment banks. Pound could go up to 135. Cable. Deal passes the first time, 15% probability. Cable could go up to 134. Deal passes the second time, 134. 35% probability. Highest likelihood being priced into the market right now is that we see an extension of Article 50 to 130. So let me take a quick look where cable is right now. Cable is trading at 128.50 area. Okay, 128.50. So we still have some room to 134 or even to 130, still 150 pips. General election. Reintroducing uncertainty, cable drops to 122, 20% probability. No deal, cable drops to 150. All right. So what you can also do is, or what I want you to do is, let's look at cable here real quick. Not cable yen. Let's look at cable. GJ, pound versus yen is also a good pair, obviously, to take a look at. But let's take a look at cable together. Here is the account. What you want to do, please, what I want you guys to do is to mark off these important levels, 128.50, 126.50. Above that, look at 129, 129.5, 130, etc., etc. Why? Because those are option numbers, and the option market has a very large influence on the spot market. Okay? All right. So hopefully you took note of this. This is a very good picture. This is a very good picture. This is basically the roadmap. And if you don't make any money tomorrow, I don't know how to help you. I will be sitting there, 8 p.m. my time. The vote will come in. Liquidity will be withdrawn. Market makers will take out all of their liquidity. On MT4, you will see gigantic big candles. Means nothing. Means some idiot is hitting the sell button, sell market, and somewhere there is a buy limit by some investment bank. Toronto Dominion buys at 115, all right? And somebody at 128 hits sell market. Boom, you're being filled at 115. So don't be stupid. Wait for it to actually trade or trade the futures market because there you have a real order book that you can look at. It's highly manipulated, but at least the orders can be executed. Interbank market, you can always have stress and discussions after a meltdown or a flash crash, and people start court dealings where a price should have been or would have been. Same with 2 weeks ago, the flash crash. Lots of people having lawsuits right now because of that, because the market makers at the big banks are not honoring some of the trades. Yep, it's an interbank market. Interbank means lawsuits. It's not an exchange. Anything traded on the exchange is solid. All right, off we go. We have a few more slides to go through. We have U.S. earnings season. U.S. earnings season in full effect this week. And the earnings per share growth is expected to slow down. The growth is expected to slow down. We're not talking about an earnings per share recession here. Why is it expected to be slowing down? The fiscal stimulus effect is starting to fade. What does that mean in English? We're talking about the tax reform by Trump, all right? That actually helped the economy. Worst timing ever at the peak of the market when everything was super, when you have unemployment below 4%, to come out with a fiscal stimulus plan. Horrible, horrible timing. Very, very, very bad timing. You would want to have this done in the recession, if and when the recession hits, and it's not hitting yet. Again, definition of a recession, 2 quarters, consecutive quarters of negative GDP growth. We are nowhere near that at the moment. We are expected to grow in the US by 2.5% annual growth rate. All right. So no recession right now. Growth momentum is coming off and oil price depreciation is slowing, potentially even reversing into a long. We'll have to watch that. Bottom-up consensus, these are the estimates, right? And in September, EPS growth estimates for 2019 were at 12%, and that's currently at 8%, and some analysts are expecting it to drop down to 5 to 6%. So all of this is being priced in right now, right? Then in the news, get this, Apple cut revenue guidance, Macy's cut profit guidance, the shares plunged. Then we had Barnes & Noble cut profit guidance, FedEx cutting profit guidance, American Airlines cutting guidance, Delta cutting profit guidance, Kohl's plunge in comparable store sales, Ford, the automaker, cutting jobs in Europe, Jaguar cutting 10% of its workforce, BlackRock, the largest asset manager ever, announcing will cut 500 jobs. State Street, the largest depot bank, cutting 50% in senior management. That's actually a good thing. AQR announcing job cuts. United Tech ended its sales of CHOP as the bids were too low. So here is the real economy actually slowing down and the companies talking to the market, i.e. to the analysts, and saying, hey, guys, we are cutting our guidance. We are not being able to deliver what you guys expect us to deliver. All right. Then focus this week will be on bank names. We have Citi this morning. We have JP Morgan and Wells Fargo on Tuesday announcing earnings. Bank of America, BlackRock, Goldman, and Schwab on Wednesday. Schwab, you want to take a look. Hey, my traders, hello, wake up. Schwab, we want to take a look because it's a retail online trader. We want to see what the retail market is doing in the US. Good counter indicator, okay? And then Morgan Stanley on Thursday. Expectations are for flat to slightly down median, that's the middle, earnings per share growth for US banks in the fourth quarter. Now, trick question to my guys. Why is it difficult for banks to make money? What is the most important thing for banks to happen for them to make money? The yield curve, Sebastian. Christian, the flat yield curve. And I included a picture. Great, guys, great. For the last year, we had a flattening yield curve. And RBC says, compared to the 2-year ago period, we expect earnings per share growth to come in around 29% for banks, yeah, reflecting net interest margin expansion, resulting in higher net interest income, higher non-interest income, lower provision expenses. Look at lower provision expenses for European banks. If you really want to see how to make money, go into the data, into the balance sheet of Italian banks and look at their provisions for non-performing loans. You will go blind how shitty their loan books are, okay? And the benefits of tax reform partially offset by higher operating expenses. So banks pay you nothing in the short term for the money you deposit with them, but charge you a lot more interest expense for the mortgage, which is longer run, in the longer term. So that interest differential is how banks make their money, net interest margin, okay? And for a flattening yield curve, that's the wrong way. Banks need steepening yield curves. They need yield curves where they can charge more for their mortgages, going out on the yield curve, and not having to pay much for the money that you deposit with them. Okay, on to the next slide. Sorry that is long, but it is what it is. I'm back from vacation. I need to get back into it. And so this is the work you do. And then while talking to you, I get paid on my short in Aussie yen. All good. Canadian dollar and Bank of Canada. What happened? Friday, we have a CPI month on month, and that is consumer price inflation. It's one of the two most majorly and most important gauges for inflation and inflation expectations. If inflation rises, a central bank is expected to raise rates, and then the currency will follow eventually the rate market. So Friday CPI month on month is expected to contract by 30 basis points versus a contraction of 40 basis points last. And year on year is expected to come in at 1.8 versus December 1.7. But downside risk is to come in on a year-to-year basis to 1.6%. So lower CPI, lower inflation. Why? It's crystal clear. Why? Because during the month that they look at, gasoline prices contracted by 5.4%. Gas got cheaper. And it got cheaper than it did in the month prior, where gas prices came off 3.3. So always, always, always have oil on your charts as a leading indicator for inflation. Okay. All three measures, and that's particular to the Bank of Canada, they make it more complicated than it probably has to be. They measure common, median, and trimmed inflation. All three measures are close to 2% target, and that actually implies, based on the model, that the Canadian economy is operating at close capacity. So currently, the analysts are seeing little upward pressure beyond 2%. And how could there be upward pressure if gas is coming off? Correct. So Bank of Canada held rates at 175 last week. That was expected. And this was not expected. This was interesting. And that's why we saw some strength in the Canadian dollar, despite rates being held at 175. They raised their growth forecast for 2020. And this raising of their growth forecast actually implies a strong business outlook survey. And you need to know that the Bank of Canada actually sends out these surveys. It's of quite importance. It's very, very important to them. They are actually talking with the real economy as input variable to their models. And so currently the market expected rate hikes in Canada for March and July of this year. And that has been postponed to July and October. So for 2019, we are currently expecting the next rate hike to take place in July, and then the next one in October, and then one more rate hike in 2020. Now, again, to my guys, if economic data comes in worse than expected, what is going to happen to the expectation for the July rate hike? Lower, correct, Sebastian. Down, very good, Vedran. If this expectation that there were no July rate hike were to materialize, what direction would the Canadian dollar take? Lower, correct, Chris. Okay. When at the same time oil prices were going to 35, hypothetical scenario, what would the Canadian dollar do? Even lower, correct. So this is how you need to think, because this is how we think. Institutions plan for scenarios, just like, why do you think Nordea comes up with a roadmap for Brexit? It's for us traders, so that we have it on a little 4x4 in front of us. Why do you think these target scenarios are being played out with probabilities, and where does cable go to, and what is it called, Article 50 extension, referendum, is so that us traders in the middle of the war, in the middle of the battle, have it next to us, next to our mouse. And it's imprinted there, and it's visible, and we know where we're taking the market, okay? The analysts work for us. They work for us, not the other way around. We pay them. We traders, with our profits, pay for everybody in the bank, for everyone. And you, the client, actually pay for our profits. That's how it works. So technically, you pay for everyone. CFTC, cut positioning. There is no commitment of traders report due to the government shutdown. So let's see when the government reopens. Would be kind of nice to have that report back. Volatility, euro, slight increase. Euro's in a range though. If it were to appreciate further, only due to dollar weakness, okay? Get that into your head. The economics in Europe are horrible. We're going to see a recession in Europe earlier than we will in the US. Germany is close to a recession because our GDP is not growing. 2 negative quarters in a row, negative economic growth, and then we will be in the technical recession in Germany. Keep an eye on that, all right? So if the euro appreciates, it's only due to dollar weakness. It has nothing to do with any good fundamentals. It's horrible in Europe. Horrible, horrible, horrible. Pound, 12.88, last week 13.05. Volatility and lower pound is expected for the second half of this year. I'm repeating myself because repetition makes perfect, okay? Yen, 8.49 versus 9.48. Volatility continues to drop further. We're in an uptrend. Watch seasonalities for the yen. It's beginning of the year. You need to be aware of seasonalities for the yen. VIX, 19.8 versus last week, 21.19. All right. Big sell-off. Look at the curve for my guys. Look at where equities are versus the curve. Are we at top edge or bottom edge? And then look at the curve if we're bull steepening or bear flattening. All right, option flows. Bullish Monday London session. Aussie, pound, yen, gold, euro. Jörg, I know you're already up you're on your gold. Good trade, sir. Bearish Monday London session, Canadian dollar. For my traders, look at the flows, why I put euro for bullish. I know what our Excel sheet says. I put it for bullish. Take a look at why. All right. No, good trading, Jörg, seriously. All right. Option pricing, bullish Monday, cable. Bearish Monday, euro, dollar, and silver. It's a shitty picture. It's just, it's everything will be tomorrow. If you have time, do yourself a favor, even to learn. Watch 8 p.m. our time, sit in front of the screens. You don't have to trade or go in simulation mode. It's a learning experience. It's going to be great volatility. That is at least my hope. Trade that I took this morning, I wanted to share with you, short Aussie yen. So my alarm clock goes off, 6 a.m. I check the numbers, weaker Chinese trade data. I'm like, all right, short Aussie. I don't even have to think about it. It's like breathing to me. Risk off, risk on. I look at equities, I look at the yields, and I'm like, okay, we're in risk off sentiment. All right, short Aussie yen. Now my job is to find the trade. And my job is to define the risk to the trade. So any Trump tweet could ruin my trade, right? Anything positive out of, hey, the trade war is calming down and the Aussie will appreciate like there's no tomorrow. I'm exaggerating. I tend to exaggerate. And then we have risk on sentiment. If there was a change in risk on sentiment from risk off, the inflows into the yen will actually turn into outflows. Okay, and that's the trade. I am short at 77.78. Before I even looked at the charts, I drew this. Here's the short, and let's see if I can show you the trade. Well, I can't. It's on a different platform. I don't want to be impolite to. Oh, I can show you here. To Admiral Markets. This is Trading View. So the target is below. There's liquidity below, and I expect them to hit into that liquidity. We have to. Institutionals need volume, otherwise we can't get into positions. We don't trade small size, we trade large size. So that's the trade. We're in profit. After the webinar, I'll move the stop loss to break even, and then we'll have made 1.5% if we hit the take profit at 77.55. Obviously, the market could drop further, but it is a scalp. All right. Are there any questions? Are there any questions, guys? If not,
Jay, I think the audience is stunning as well as me for your great impact here and all for free, so it's amazing. And yeah, you answer all questions here. I think there was one last thing about the Aussie dollar and JP, the crash. Yeah, I know this flash crash.
That has to do with the crash was only due to the withdrawal of liquidity. And currently, the market is playing on a macro level an actual trade war resolution. Okay, and the recent tweets, Ulrich, that we saw coming from both sides with announcements expected for this week, both after the 3-day convention where they had talks last week. It was planned for 2 days. It was a positive sign that we had 3 days of talks, so an additional day. And then this week, both the US and China are expected to make announcements in terms of what they concluded or did not conclude yet, but it's all very positive. And so the market is ahead of the curve, playing a resumption of normalized trade relationships. If you want to have a leading indicator for US-China trade talks, then have a look at soybeans. Okay? Little bit of an insider for you here. Soybeans, great import good from China, buying from the US. Soybeans are already leading the way, indicating to us a resolution. Now, if soybeans were to come off, you can expect weakness in the Aussie yen. Has nothing to do with Australia importing or exporting soybeans, all right? Nothing. It's just that that's the great thing about our profession, is that every year you learn something new. Until last year, I was not aware that soybeans are a leading indicator for a trade war, because this is the first time in my career that I experienced a trade war between China and the US. So global economy number 1 and number 2. So this job is awesome. You make money every day, every week, every month, every quarter, every year. You make money all the time if you know what the hell you're doing. And you learn something new all the time. But it has zero positive effect for society that you need to be aware of. So do something good with the money that you're making, because you're not helping anybody. We're just pressing a mouse button. It's ridiculous. Guys, I don't want to be impolite to Admiral. I hope I see you next week. I hope you learned something. Yeah, we don't look at charts a lot because that's what we don't do at institutional level. We hardly ever look at charts. As a trader, I never looked at a chart. I price off of flows. If a lot of large clients buy from me, I'm too cheap. If a lot of large clients sell to me, my bid side is too high. I need to take it down. That's actually how you trade. All right. Thank you very much for showing up this morning. I appreciate you all. We appreciate you. Have a great week. Have a super exciting Tuesday evening with the vote. And I'm looking forward to seeing you all next week, hopefully. Thank you for coming in. Bye-bye.
Okay, Jay. Yeah, thank you very much. Here, the feedback from our audience is amazing. So yeah, thanks a lot for showing on what are going on at the markets at the moment. So and yeah, we will see us next week at